You ready?
Well,
well, good morning or good afternoon, everyone, depending on where you're sitting in the world right now. Welcome to today's session presented by Moomoo Australia, 2025 Investment Outlook. My name's Michael McCarty. I'm the Chief Commercial Officer with Moomoo Australia. And with me today is our world-famous market strategist, Jessica Amir. And together, we'll be looking at 7 key themes for 2025. And of course, we'll be looking back over 2024 at some of the key factors that drove markets and investment portfolios. So settle in. We'll be speaking for about 45 minutes and we'll then be taking questions at the end of the session for 10 to 15 minutes. So if you have a question, please feel free to enter it in the comments section and we'll try and get to as many of those as we can at the end of the presentation. But before we get started today, there's some important information for you to take note of. Please note that Moomoo Australia is licensed by the Australian Securities and Investments Commission, and our AFSL number is on the screen there for you. You can also see that we are registered here in Australia, and our ABN is also available to you. Perhaps more importantly, it's important that everybody understands that the presentation today is general in nature. As individuals, we come to the market with different goals, different investment outlooks, different risk appetites, different timeframes, different amounts of capital. And all of those differences means that the right decision for an individual depends very much on their circumstances, in fact, as much as it does on the market itself. So the decision about whether any of the information presented today is useful to your situation is a decision entirely for you. If you're unsure, particularly about any of the risks that we discussed today, please seek independent advice. So with that important information in mind, let's have a look at today's agenda. We'll be crossing the 7 themes that we have identified as potentially driving markets in 2025. This is, of course, forward-looking, and none of us know the future with certainty. But given the action that we've seen this year, we're looking for a number of themes and trends to continue into 2025, potentially offering market opportunities for investors and traders. And one of the most notable aspects of trading in 2024 was the ongoing boom in ETFs. Now, this has been a long, slow boom. ETFs have not suddenly arisen out of the ground. In fact, exchange-traded funds have been traded in Australia for more than 25 years. It's a similar situation in the US, where it was in the 1990s that ETFs first started to gain in popularity. And one of the key reasons for that is the nature of ETFs themselves. An ETF is very flexible. When we talk about ETFs, we're talking about a universe of investment products. Now, the very first ETFs focused on indices, on the NASDAQ, on the S&P 500, and here in Australia, and the Australia 200 index. And the compelling aspect of ETFs at that time was the ability to gain exposure to a diversified portfolio of stocks in a single transaction. So not only was it much more convenient to take a market-wide exposure, it was a lot cheaper because there was only a single brokerage amount to pay on that transaction that gave exposure to, in the Australia 200 case, 200 stocks. So that compelling aspect of ETFs saw them grow in popularity, particularly with longer-term investors. Many Australians use a core and satellite approach to investment. That is, they hold a core of stocks, which often contain ETFs, and then take satellite investments around that steady core. And ETFs are well suited to that sort of approach to longer term investment. But of course, the financial engineers of this world didn't sit still. And once the power of ETFs had been discovered by investors, mainly via index ETFs, they started to get creative with them. And now there are tens of thousands of ETFs available to Australian investors, both here listed on the ASX, but also importantly listed in the US and in Hong Kong. And that collection of ETFs available to Australian investors means that it's possible now to get exposure to investment themes that Australians simply couldn't get involved in previously. So we've seen those ETF issuers grow along with the market and along with the amount of money invested in ETFs. And these days, ETFs offer all sorts of exposures. Now, it's very important that anyone thinking about investing in ETFs understand what it is that that particular ETF delivers. You can find that information on the Moomoo platform, but it's worth exploring because there are so many themes that previously were unavailable to Australians, which are now available. I was fascinated to see a platinum trust. Most recently, very difficult metal to get direct exposure to, and yet there's an ETF that will do that for you. But it doesn't stop there. If you want exposure to cryptocurrencies, but you don't want to go through the hassle of setting up a wallet, or you're not comfortable with the risks of trading on unregulated exchanges, you can buy an ETF that wraps the exposure of those cryptocurrencies into an exchange traded product. And so you get that safety of something that's being backed by a big name and trading on a known and regulated exchange, but you get the exposure that you want. And very popular this year, and particularly with that focus on the fast moving US stocks, the tech sector there, and the magnificent 7 stocks that led the market higher, we've seen a lot of ETF suppliers respond by issuing ETFs over individual stocks. So NVIDIA was one of the most popular stocks that we saw ETFs issued over this year. And it wasn't just straight exposure to NVIDIA. There were 2 times leverage and 3 times leverage ETFs. There are inverse ETFs that go up in value if the price of NVIDIA falls. And there are 2 times inverse ETFs that double the falls in NVIDIA if it does tumble. So these sorts of ETFs are very specific and tailored exposures, particularly useful to those who have an idea about where they'd like to go, or have identified an instrument or market that they'd like exposure to. ETFs can be a very convenient way to get exactly the tailored solution that you're looking for your investments. So we expect the boom to go on. You can see the list on the screen at the moment has the 5 most popular ETFs that we traded on the Moomoo platform over 2024. And you can see that the focus was very much around those US exposures. Just outside that list, though, were some perennial favourites amongst Australian investors, including an Australia 200 ETF and an S&P 500 ETF. So very popular still. A lot of buy and hold investors favour the larger ETFs. A lot of trading participants on the Moomoo platform favour those more leveraged ETFs. And whatever your approach is to markets, in the ETF market, you can possibly find the exposure that you're after. So we're expecting this trend in ETFs to continue. The economics of using ETFs as part of an investment approach are quite compelling, at least in my view. And for that reason, I expect that 25 years of solid growth we've seen in ETF markets and the boom we've seen in trading ETFs to continue today. So ETFs certainly on everyone's menu, Jess. There have been a number of key themes over the course of this year that have really caught investors' attention, and the AI wave was one of them. To tell us more about artificial intelligence and the way investors took exposures to it, Jess will take over.
Thanks, Michael. Great introduction. So really fascinating to see, I guess, the dominance of AI and how it's really taken the US market to brand new record all-time highs overnight, but indeed this year. And we can see that NVIDIA is, I guess, the pick of the bunch. NVIDIA has become the world's biggest company by no misadventure. So 40% of their clients are blue chip companies. So that includes Microsoft, Meta, Alphabet and Amazon. And with this growing source of, I guess, earnings growth fueling NVIDIA higher, their revenue growth has now eclipsed the market, and their revenue growth is an outstanding triple digit, 151% revenue growth this year. And that's indeed perhaps one of the reasons why a lot of Moomoo traders and investors have been buying NVIDIA. They've been chasing up their record share price growth as they continue to hit new all-time high after new all-time high. I guess what is also interesting, to go back to your point, Michael, about clients using ETFs to take a particular view of a stock. You mentioned the leveraged ETFs. And so on our platform, we're seeing the NVDL, that's a Granite Shares ETF that offers leveraged exposure to NVIDIA, and that has been a very popular trade or investment at Moomoo. So we do know, if we think about NVIDIA, just flicking over to the next slide if we can see that NVIDIA shares are up and outstanding almost 200% this year. But the NVDL, which a lot of our clients are indeed buying, that has gone up by some 400%. But nevertheless, at a broader, bigger picture, why do we believe that this AI megatrend can continue, and why perhaps should it be on your radars? Well, it's the fact that this industry is expected to see the strongest earnings revenue growth, not just for next year, 2025, but probably more so for perhaps the next decade. And this is not just us thinking this is the consensus estimate in the market. So we're looking at a compound annual growth rate or revenue growing on average every year at 42%. So this is compelling and also supporting stocks in this sector higher. It's not just NVIDIA, but it's also the services companies, the software companies that are providing software to companies such as the ones that perhaps we work in and you work in. So companies like Microsoft, Salesforce, Palantir, etc., they're increasingly buying NVIDIA chips and also providing end-to-end solutions for corporations. And these companies, such as Palantir, are seeing record share price growth. And so this week, in fact, tomorrow, Michael, in the US, we'll find out if Palantir will be added to the NASDAQ 100. So Palantir is a very popular traded stock at Moomoo, and I guess there's a good reason for that they're gaining a lot of market share. Big corporations in the US, including Microsoft and NVIDIA, are using their chips, and a lot of corporates and US government organizations in the US are using their chips. But just rounding it all out, we do believe that the AI wave will continue to dominate markets, not just for next year, but perhaps for the next generation to come, because the AI, I guess, wave is really just in its infancy, with the majority of the AI chips and software companies, I guess, at the backbone of that. The core customers are really tech companies, but we're yet to see the breadth of demand extend to other sectors and industries, such as healthcare, machinery, real estate. So I guess it's really exciting to see that this is in its infancy, and we're yet to see companies like the healthcare giant, that came up with that novel solution, Ozempic. We're yet to see their revenue, I guess, hit NVIDIA's bottom line. That's just an example of how you can expect the broadening out of revenue growth in some of these names that we've mentioned. But yeah, all in all, it's not just the tech companies in the US that are benefiting. It's also down under names like NextDC, a data center company, Technology One, that's also doing business with Microsoft. They're born out of the ASX. Those companies are also benefiting from this huge pivot to AI. And then rounding it all out, because of the unprecedented growth and pressure on the US grid, taking it back to the US, we're seeing companies like Vistra and Constellation Energy see a lot of demand from AI companies. So believe it or not, I think the fact is 10% of power in the US grid is now, I guess, coming from data centers. And perhaps that's why companies like Amazon are increasingly tapping Constellation Energy for uranium, just so that they can power their data centers with cheaper, more carbon neutral electricity. So when we're thinking about the AI wave, just closing this off, we're not just thinking about the semiconductor companies, which we've mentioned there, NVIDIA, but it's also the services software companies such as Palantir, and last but not least, the uranium companies. But everything, I guess, hit new record all-time highs overnight. tech stocks, the NASDAQ 100 hit record all-time highs, and perhaps that's something to do with the rate cuts that we can expect next week. Michael, this is your forte. You've been in the industry a lot longer than me, believe it or not. We probably look the same age. But
You're too kind, Jess, too kind.
Why don't you tell us about this?
Well, it is an interesting one. It's a story that's been going on for a long time. But the actions of central banks, particularly at times of crisis, have been key drivers of markets. It happened after the GFC, and it happened again during the COVID pandemic. We saw central banks spring into action and introduce the easiest monetary conditions we've ever seen. They made modern history by slashing interest rates to zero. Now, since we've seen the globe emerge from the restrictions imposed for the pandemic, we've seen economies bounce back. And in fact, if anything, economies overheated as they sprung back to life as people emerged from the restrictions. That big spring back in the economy was concerning. While it was good to see the growth return and the pent-up demand feed back into the global economy, it sparked inflationary moves. And inflation is a very difficult beast to tame. The reality is, once inflation gets out of control, starts to spiral, it's very difficult to get it back to a reasonable level. And it's why central banks are so vigilant on the risks of rising inflation. And it's why in the US, for example, there was such a brutal run in interest rates with monthly lifts in the rate that took them from 0% to above 5% in a relatively short period of time. And of course, as markets and investors adjusted to those changing interest rate environments, it had significant impacts. However, since a slowdown in the US economy in particular this year and concerns about the global outlook, we've seen the Fed move back to an easing bias. In fact, it has cut rates at its last two meetings and is widely expected to cut rates again next week when it meets on December the 18th. So those factors have been key. Markets have reacted very strongly to even the suggestion of interest rate cuts to come. Just a whisper from a central banker, from a Fed speaker in the US, can send share markets higher. And when they actually deliver the cuts, we tend to see solid gains in the intervening days and weeks. So that factor does look like being very important in the US. There's a couple of small caveats, some things that we do have to watch out for. Now, at the heart of every central bank's mandate is a demand from the people who set up the bank that they manage prices and unemployment or employment in the economy. That is, they need to keep jobs at a reasonable level and they need to keep prices under control. And that reiterates that stance against higher inflationary pressures. And now that has eased, we've seen the central bank in the US at least move to its easing bias. But if we pull up the chart of inflation in the US, we can see that there are reasons for investors to be alert about the rate cutting cycle. Now, at the moment, the record highs in the US reflect expectations in the US that we'll continue to see interest rate cuts from the Federal Reserve throughout 2025. So it's any changes to that assumption that could really move markets. Now, if we saw inflation drop further from where it has dropped, and you can see on this chart from the peaks that we saw as we emerged from the pandemic restrictions, we've come right back down to much more reasonable levels, at least as far as the Fed is concerned. Now, we know the Fed is looking for a 2% long-term sustainable rate of inflation. So as we approach that 2%, the speculation around the potential for rate cuts grew very fast. We're likely to see that go on as long as inflation remains trending downward. Now, this chart is showing the PCE. This is the deflator factor of the national accounts numbers. It's not the monthly inflation figure. And it's known that the Fed focuses on this PCE as an academic output of the national accounts in determining the trends in inflation. Now, the concern for investors should be that tiny uptick that we saw in the latest reading. And if that uptick continues and inflation starts to trend upwards, I'd suggest that rate cuts are much less likely. And if that perception starts to spread in the market, we could see significant corrections in US shares. So that's something to watch out for. While it trends downward, the assumption we'll see further rate cuts is a pretty safe one, at least in my view, and could be supportive throughout 2025. But the big caveat on all of this, and particularly those markets that are relying and have risen to giddy heights on the back of expectations of further rate cuts, are vulnerable if inflation ticks higher. So not necessarily the biggest risk that investors are facing, but it is a significant one. We know that the US share market in particular has global leadership, along with a number of other key economies. And that global leadership means if we do see corrective activity in the US, that selling is likely to spread around the world. So something to keep on the radar throughout 2025. Keep an eye on the US PCE just in case.
Well said, Michael. And I think that answers two of your questions. Will we see a pullback in 2025? I think Michael gave you some really handy hints there for what you could look out for a potential pullback. We haven't yet seen a pullback of 10% in the S&P 500, but I think that might give you some clues as to what you should or could be looking out for. So not just inflation, maybe keep an eye on the VIX index, and you can track that on Moomoo's app. Changing pace now, we've seen, record stimulus out of China, and perhaps this brings about the reason that we believe emerging markets will increasingly be a part of investors' portfolios, perhaps in 2025. Michael, what can you tell us?
Well, up until September this year, China-exposed stocks in particular were very disappointing for the investors that were holding them. They were under a lot of pressure. There were concerns about the growth outlook, particularly in China. It's, of course, the most important of the developing nation economies. And the concerns about the growth outlook had really weighed on China-exposed investments, and in particular the Hang Seng market. Now, on the 25th of September this year, the chair of the People's Bank of China announced new stimulatory measures in monetary policy that immediately caught the attention of investors, not just in China, but around the globe. And the response to that announcement, and then further announcements and accompanying fiscal stimulus as well, really turned around thinking on the growth outlook in China. And there's now a lot of confidence that the goal of 5% growth in the economy in China will be achieved this year, given the introduction of those new measures. And that, of course, changed the outlook for investments. We saw a huge run up in the Hang Seng. Now, it did appear that the rise was too sharp, too fast, too far, and the pullback that occurred retraced about half of the gains we'd seen in the immediate aftermath of those announcements. So we've now seen the Hang Seng steady up around the 20,000 mark, and that steadiness, I think, is another reason why we're starting to see further announcements out of China about measures to keep the economy growing stably, and those measures have changed the outlook. Now, that certainly aids all of those China exposures, but also alongside that is a valuation argument around the globe. With US markets, some of the European markets and markets here in Australia, all near all-time highs and all with very stretched valuations, it makes sense from a global point of view to be looking around the world to see where we might get a better value proposition. And the Asian markets in particular, into India, are of particular interest because the valuations are so much more attractive. Now, we have seen good support for the Nifty 50 recently in India. It has risen, but on a valuation basis, whether we're looking at the Kospi in Korea, the Hang Seng in Hong Kong, or the Nifty 50 in India, we've got a valuation argument. Whereas we're seeing PEs of 20, 25 times in many of the global markets that are near all-time highs, and in the case of the NASDAQ, closer to 35 times. Prices are 35 times earnings at the index level. We're seeing much more comfortable valuations in the Asia-Pacific area, and across Korea, across India, across Hong Kong. We're seeing valuations that indicate PEs are closer to 14 to 17 times. So much less stretched and potentially greater room to move if investors spotlight turns to those regions. So we're favouring exposures in 2025 to particularly Hong Kong, but also to China, India. Sorry, of course, Hong Kong is China, but we like the listed instruments there because of the easy access. There are many other ways, of course, to get exposure to the Chinese economy, including locally listed ETFs and ETFs listed in the US. And it's the same for Korea and India. If you want exposures, there are locally listed ETFs that will give, for example, exposure to the Nifty 50 or to the Kospi. And so investors who are looking to diversify, who perhaps are concerned about stretched valuations in some markets, could consider employing the power of diversification and moving into those developing nations or those emerged nations that have much more attractive valuation measures.
I think it's also really fascinating to see. You're just having a look at Bloomberg this morning, and among the global ETFs that we can see, Chinese ETFs are garnering the second most amount of fund flows this year. So just outstanding stuff, Michael. Thank you very much to everyone who's been popping in questions. We will get to your questions at the end. If you do have any questions, please type them into the Moomoo app. And any questions we don't get to, we'll be taking up on the Learn Premium section of our platform and answering those in due course. But let's just perhaps move on to one of the other key themes that we believe will garner investors' attention and is indeed causing stocks, I guess, to flurry in the last couple of weeks. And that is, of course, with Trump expected to take to the White House. Inauguration, of course, January 20. But what does Trump bring? What does Donald Trump bring in his second term? Well, I guess the thinking is that he brings less regulation, less red tape, and potential tax cuts. And he's also looking at ways, novel ways, that he can reduce, or the Trump administration can reduce the US government debt. And one of those ways is by bringing Bitcoin in as a US strategic asset. Of course, the US administration via the US Treasury already holds some 207,000 Bitcoin. That's 207,000 Bitcoins. But the US Trump actually wants the US to make Bitcoin a strategic reserve, just like gold. So that would mean that they would be buying it, and buying 1 million Bitcoins over some 5 years, I guess, really to inflate the price of Bitcoin to offset their debt levels. So that is something that is a consideration. The other thing that we've been speaking about with clients, and indeed some of you chatting to you on the platform, is we've been speaking about Tesla. And I think Tesla, I guess, could be seen as a key benefactor, a key winning stock with Trump in the White House. Indeed, it's been one of the most, it's been a stellar runner. So its shares have been up some 70% since the election. And overnight, believe it or not, Elon Musk became the first person to exceed $400 billion in net worth. That's the latest. That's the latest world standard for billionaires. So just outstanding stuff, and a big kick up in his net worth is obviously to do with him being head of or co-head of the Doge. So that Doge, this new department that was set up. So with Elon Musk running alongside Vivek to head up this department, it's all about cutting red tape in the White House, and also about cutting excessive costs. But why are we talking about this when we've got a chart of Tesla? Well, obviously, Tesla shares surged overnight, as we said in our daily report this morning. They surged overnight to a brand new record all-time high of $424. That's their first record high since 2021. But I guess the market is now thinking that more hot sauce, more alpha, more upside, whatever you want to call it, could be ahead in 2025. Why? Well, we're waiting for two key catalysts for Tesla. And I know a lot of you tuning in today, and a lot of your questions are also about Tesla as well. Tesla's a hotly traded stock. It's also tightly held by some Moomoo investors. So why could you expect Tesla to maybe up its ante in 2025? Well, it's all about full self-driving and the cyber cab. So GM in the last couple of days, General Motors has axed their cyber cab division, their basic full self-driving division. We do know that Tesla recently in China got the green light to roll out full self-driving FSD. That's in conjunction with a collaboration that Tesla has got with China's Baidu. But basically, all in all, there's two key divisions that are expected to gain regulatory approval sooner than thought. And that is why Tesla perhaps should be on your radar if it's not already. It is, again, just worthwhile mentioning that a lot of you are trading and investing in Tesla and also leveraged options, or rather not just options, but leveraged ETFs in Tesla. So well done to those that have been who are a little bit richer because of Tesla. But let's just move on to another key theme that we think will dominate 2025, and that is Bitcoin. So we've seen the price of Bitcoin hit a brand new record, all-time highs overnight. The price of Bitcoin rose over $101,000 for the first time in history. Some people out there still don't really understand why Bitcoin is rising so much. So
I'm one of them, Jess.
Okay. But believe it or not, there's three key ETF themes, excluding the single stock ETFs that are dominating ETF buys and ETF transactions. And one of those key themes is propelling Bitcoin to new all-time highs. And that is that investment managers around the world are now allocating a portion of investors' funds to Bitcoin. And this is why Bitcoin is the second most bought area of ETFs in the world. Obviously, the most flows into ETFs this year are continuing to go into the S&P 500. Of course, the S&P 500 is the pin-up index, the benchmark index in the US. You can only get into that if you've got 4 consecutive quarters of profit growth. So there's a good reason why that index is up almost 30% this year. But just thinking about Bitcoin, just reiterating and driving that home, we're increasingly seeing institutions and also now retail investors buying into Bitcoin via that ETF that Michael mentioned, IBIT. That is the biggest holder of Bitcoin in the world in terms of an investment that is listed on the New York Stock Exchange. Of course, if you are looking for, as a lot of you know, on Moomoo, a lot of you are trading and holding MicroStrategy. And thank you for your questions about MicroStrategy. But MicroStrategy is actually the biggest corporate listed holder. That's a bit of a mouthful of Bitcoin. So MicroStrategy, Michael Saylor's listed investment company, I guess, if you will, they're holding 400,000 Bitcoins. And of course, Michael Saylor said that he wanted to buy more Bitcoin. And if he does that, that would, I guess, be another support measure to push the price of Bitcoin higher. So you've got institutions, retail investors, and large corporates buying Bitcoin. The other reason, just before we close this off, why could you expect Bitcoin to hit new records, and why perhaps should it be on your radar for 2025? Well, with the inauguration of Trump, just recapping that off again, if we do see the US Treasury go ahead and greenlight Bitcoin as a US strategic reserve, driving that message home again, that simply means the US government would look to buy Bitcoin and hold that on their balance sheet just like gold. And the reason that they are wanting to do that is just simply so that they can manipulate the price of Bitcoin, believe it or not, to push it up higher. That's what Senator Loomis has said, to push it up higher because they're going to cap selling in Bitcoin. So they're looking to buy 1 million Bitcoin. That's worth $100 billion over a 5-year period to inflate the price of Bitcoin so they can offset government debt levels. So that is just outstanding.
Indeed.
Something else that's outstanding is the Aussie share market. So the Aussie share market is trading in record all-time highs, not as high as the US though. And Michael is our man to tell us all about the Aussie share market. What can we expect?
Well, Jess, it's been a good year for Australian investors. You've touched on those all-time highs that we've seen in this last month of the trading year. And you've got to add on to that, a lot of global investors forget that the dividend yield on the Australian index is superior to most global indices at around 4% plus franking, which can gross it up to around 5.5%. It's a very solid return. And of course, investors who are focused on dividends and income returns from their share portfolio can select stocks using a higher dividend filter and come up with even stronger portfolio yields. Now, of course, dividends are not the same as investing in a bank, and that dividend yield does vary over time as dividends go up and down. But the consistency over many years has given a lot of investors comfort that that's an approach they want to take. Now, one of the reasons we've seen such a strong performance from the Australian share market this year is the big performance by banks. We saw gains in major banks, and all 4 of the major banks are top 20 stocks, by the way. They're very large companies. And those gains of 25 to 30% during the course of the year really turned around a lot of portfolios. Unfortunately, a number of people had remained underweight banks. There were good reasons for that, going back to the Royal Commission of Inquiry into the banking sector in 2017, 2018, and the fallout from that inquiry that had banks provisioning for penalties and making repayments and remediation to their customers. And that, of course, slowed down earnings. It distracted management. They had to focus on fixing the wrongs of the past rather than guiding their businesses forward. And we also saw a lot of concern about the lack or the loss of social license and the lack of popularity amongst investors for those banks. So all of those factors had weighed on the sector for many years, for at least 5 years. And so the banks, oddly enough, had gotten to a position where they were undervalued. Now, with most of the issues from the Royal Commission addressed and many of the balance sheet factors cleaned out, and with bad debts not rising anywhere near as badly as was feared during the pandemic, the banks were actually left in a strong position with good balance sheets, reasonable margins, and some room to move. And of course, movement in interest rates is also good news for banks. When interest rates are moving, there's a chance for them through lagging or leading other rates that they can increase their interest margins at times when interest rates are moving. So if you're concerned about how much you're paying on your mortgage, you can get your own back by holding a bank and earning its dividends to at least offset some of what you're paying in mortgage rates. But that certainly was an approach a lot of investors took this year. That big performance from the banks drove the index. The other major sector for the Australian market did not perform. That, of course, is the resources sector. We've got the major miners and a number of global miners based here in Australia. We've got the largest exporters of iron ore anywhere in the world and some of the biggest copper and gold mines anywhere in the world. But we've also got a very vital energy sector. And of course, coal stocks and gas stocks have been under extreme share price pressure for many years as the Australian economy and many other economies around the globe make a pivot towards more renewable forms of energy generation. Now it's becoming apparent that the plans to switch electricity systems over fully to renewables are not likely to work out. And there's been a bit of a resurgence. It started with the outbreak of hostilities in the Ukraine and the disruption to gas and oil supplies into Europe from Russia. And that drove a global rally in gas prices that really turned things around for a lot of these energy companies. Now, unfortunately, that also saw a legislative response from the government here, and it legislated away some of the profits that those, particularly those gas producers, would have enjoyed after years of investment and underperformance. But nonetheless, despite that, we've still seen some support for energy stocks. So those are the two major sectors. Between them, they make up about 70% of the Australian market. And just as an aside, that's why so many Australian investors do include international stocks in their portfolio, because not only does it give them international exposures and more diversity in that way, they get exposure to indices that are not well represented on the Australian exchange. So, but with those two sectors dominating, the banks doing so well, resource stocks underperforming, not just the market locally, but the globe, there are reasons to examine these two as the potential drivers of any performance in the Australian share market. Now, the rise we've seen in the banks, to my view, just brings them back to a fairer valuation, a more long-term valuation. And I'm not concerned that they've risen unsustainably, unlike a lot of other stocks we've seen around the globe. But the resource sector has been perennially biffed by markets and investors. And the reason for that, particularly here in Australia, was a very subdued outlook for growth in China. And now that we've seen that turnaround with the response from authorities in China, there should be a turnaround, in my view, in the performance of resource stocks over 2025. And in particular, I'm focused on the energy sector. I think you've got a potential double lifting effect here in the sector. One is undervaluation because of that shunning that's come around, based around mainly on ideology rather than the businesses themselves. The underlying cash flows in many of these businesses look very strong. In Woodside's case, for example, and that's the Woodside share price on the screen right now, we know that most of the gas they produce is under long-term contract to long-standing customers. And so while the potential for huge gains should the gas price rise are not as solidly represented in Woodside, the fall that we've seen in its share price could also be viewed as overdone given those long-term commitments they have from their customers. So Woodside is one that's definitely on my radar for 2025. I think the sector is undervalued. I think that the whole world and Australia is coming to a dawning realisation that the proper energy mix for nations, and particularly the electrical systems of nations, does require some firming agents, and that gas is very well suited to play that role in Australia and in other nations. And I think the growth outlook for the globe has also been underestimated. So we've got subdued resource prices based on a subdued outlook for global growth. I believe that's turned around with the announcements that we saw out of China over September and October, and I expect to see that resonate through the resource sectors over the course of 2025. And I've got a particular focus on those energy stocks because of what I see as undervaluation in the sector. So something that could well drive local investment markets. What that means for the Australian share market, in my view, is we're likely to see further gains. I read a great essay just this week looking at returns and investor expectations around returns. And Jess, when asked how they think the share market will perform, most investors respond, oh, it'll go up by between 7 and 10%. Now, guess what the long-run average return over the last 32 years in the Australian share market is? It's between 7 and 10%. And so what investors are doing, they're basically reflecting back what they expect over the long term. The interesting part of this essay was in 28 of the 32 years of the study, the last 32 years, the market was more than 5% away from that return. In other words, averages are misleading, and the average experience over that 30-year period is not a good guide to what might happen. So I've seen a lot of estimates so far of the share market this year showing gains up to about 10%. That is up to about 9,000, and nice. a lot between 8,500 and 9,000. That looks to me very much like the average return. I'd point out that the future is always uncertain, and in 28 out of the last 32 years, we did not achieve the expected return. So it's a good reminder to all of us. Risk management's always important in investing, but I think it's going to be particularly important in 2025. It's important investors take account of their own situation, but at least consider your risk management strategy. It's going to be very important, particularly if, as I expect, we see volatility in markets pick up. We've already seen signs of that pick up over the last few months. We've seen spikes in volatility, and the returns now see volatility coming down to levels that are above where they were previously. In other words, there appears to have been a permanent impact on volatility levels, as well as the temporary one that we see normally in a sell-off or melt-up situation. So that increase in volatility means that we're more likely to see scenarios where the risks that we're taking hurt us before we get the chance to collect the rewards. And for that reason, it's important to remember all the tools at investors' disposal. Now, more sophisticated investors might use, for example, US index options to hedge their portfolios. Others might prefer to use an inverse ETF and include that in their portfolio. So if the broad market does fall, they'll at least have one instrument in their portfolio that's more likely to go up. Others will simply use the power of diversification and spread themselves across sectors and across countries so that even if all markets fall, they are spread and they're ready to take advantage of any recovery. And of course, some long-term investors might simply ride out the volatility. The decision about how to manage your risk is entirely up to you. But I'd stress, as we head into 2025, the pickup in volatility we've seen in the second half of this year suggests that we're likely to see further increases in volatility, and it is a very good time to be considering your investment and trading risk management strategies. I think that's a good note to sort of finish on, Jess.
That is a wonderful note to finish on. I'm just wondering if you've got time to take questions. I think we do.
Sure.
But that concludes the 7 key themes that should be on your radar for 2025. So please keep your questions coming through on the Moomoo community. I do believe that Michael has answered some of those. One of those was about a potential pullback, and we spoke about what could trigger a potential pullback in 2025. This question here, I'll just I won't read out your name. Do you think a pullback is likely, given what we've had this year, even though we don't have any interest rate cuts as originally expected? I think we can paraphrase that, and yeah, we have had interest rate cuts in the US, but sure, we haven't had any in Australia. Potential pullback, Aussie share market, US market.
Can never be ruled out. And that's the thing about it. The future is inherently uncertain. And it doesn't matter how hard we work, how intelligent we are, how much experience we have, none of us know the future. And so we can only prepare for what might happen. And being prepared for a pullback is a very good idea, in my opinion. The thing about it is pullbacks occur because there's a surprise. There's something that changes the way that the market is thinking very quickly. And by their very nature, surprises are unpredictable. But we do know that there are certain factors the market is leaning on, and if they were to change, it could change the perception. Now, I touched on what I think is the key risk for next year, and that is that inflation remains a lot stickier than the markets are currently expected. A lot of the positive views that we're seeing around the globe and we're hearing and reading in commentary are based on the idea that there will be an easy monetary environment next year, and that is dependent on inflation remaining tame. So any pickup inflation will derail that whole interest rate cut expectations, or it might see it kick down the road, but either way, it's likely to see deferral, and there's potential for that to hit markets everywhere. We're just as much at risk. I note that there's still one of the major banks predicting a rate cut for February, whereas the other three are all expecting a rate cut in Australia in May. I am not certain that that will be the case, and I think that the governor of the Reserve Bank this week was very clear, and the statement put out that accompanied their interest rate decision was very clear. They don't see inflation returning sustainably to their target level until 2026. And to me, that's a very clear warning that the RBA is not expecting to cut rates at all in 2025. But you'll have to read the statement for yourself and form your own view. But if that view does spread, that could also be a trigger for a correction in the Australian market. So that's in my book, the key risk and the key potential for a pullback. But of course, there are other triggers. It's all at the moment about growth. And if we see growth fall off a cliff, the potential for governments and central banks to respond is lower. Governments' balance sheets are bloated with debt. Many governments are getting towards the reasonable limits of the amount of debt they can issue, and that means their ability to stimulate weak economies is greatly diminished. It's a similar situation with central banks, where while many have started to decrease the size of their balance sheets as they unwind all the accommodation of the pandemic era, the reality is they still have limited capabilities, and there's now further questions about how effective cutting interest rates would be in stimulating the economy. So the idea that the the central banks and the government are providing a put under the market could also suddenly change. If we see a mini crisis and we don't see the response markets are affecting, that could deepen any sell down in the market. So just something to be aware of. There are, of course, many other potential triggers for sell downs in market. Political instability, geopolitical developments. We're already facing some pretty dire situations in different parts of the world. There's concerns now as we head into 2025 about political instability in Europe. Now, as the third largest economy in the world, that's also a potential source of trouble for the world. So there are a lot of potential risks, is all I'm saying. Not all of them will come to fruition, but investors should be aware that those sorts of risks could trigger a correction in the markets at any time.
Thank you, Michael. I think that answers your question. And I will just answer someone's question that's come through online in front of us now. We'll be publishing today's information on the Moomoo app. Absolutely. You can head on over to either myself or Michael's bio, and you can find today's webinar.
Or join the conversation in the Moomoo community.
Absolutely. Also, just going back onto what you were saying, Michael, about rising debt levels, geopolitical tension picking up. I think I like that you said, diversification. That is a great way to, I guess, cushion your portfolio in case we experience a pull down, and in case you're not one of those people who is into monitoring your portfolio on a regular basis and taking profits off the table once you hit your 10% gain or 20% gain, whatever it is. So diversification plays a big part of cushioning the blow when markets pull back. And to that end, I would say that I would encourage you to not only look at other sectors, but also look at gold. So gold is potentially a safe haven, and gold, of course, does well in times of geopolitical tension. And the narrative for gold looks, I guess, somewhat bullish again. And now that there's a potential rate cut on the cards next week, 99% chance, according to what traders are betting just before we kicked off this webinar. I want to get back to a question about a potential pullback. This one is really interesting about the banking sector in Australia. Banking stocks, for those that aren't aware, banking stocks such as CBA have been trading at record all-time highs in that neighbourhood. And this viewer or this Moomoo user has been asking about the banking sector and your outlook for that in Australia, just in view of what you said about interest rates. I think it's quite interesting.
Yeah, and I certainly, as I mentioned earlier, I think that what we've seen, that huge rally we've seen in the leading banks in particular, but in all banking stocks, is a recapturing of lost territory. That is, they were trading at depressed levels because of the troubles that faced the sector. A lot of them, let's face it, were self-inflicted, and the issues that the banks had to deal with as they came through the pandemic. So that combination of factors had depressed banking share prices across the board, in my view. And the big rally that we saw in the banking sector this year was a game of catch-up rather than a fresh rally. And so for that reason, I think a lot of the gains are sustainable. I do note that the banks now regularly come under pressure that sees them knocked down 2 to 5% at various times. But to me, that's indicating that they've found a new valuation level. So while I think a lot of the gains have been made, or a lot of the easy gains have been made, and it'll now be up to the bank management teams to start delivering to the bottom line, the reality of that revaluation and the fact that they still are maintaining very solid dividend yields suggests that the gains that have been made are sustainable, and I'm not fearful for the outlook for banks in particular. Of course, if we do get a sell down across the board, every major stock will be affected, and the banks are very prominent on the Australian bourse. So if there's general selling, then they will come down with the market. But I think the years of underperformance that we've seen in the banking sector are over.
I think it was also really telling that perhaps a leading indicator, construction work done, is actually rising far more than expected, and perhaps that would suggest that mortgages might be increasing and mortgage demand could be increasing. So to that effect, just backing up what Michael is saying, you'd think that their earnings could potentially be turning around, and that might suggest further share price growth. But also, just adding in my 2 cents as well, we do have to think about CBA being the world's, or being Australia's biggest company. BHP is number 2. But there's a good reason why, regardless of their profits or net interest margins, which we look at, they've been declining. But their shares continue to hit record all-time highs, and perhaps there's a lot to be said about Australia's superannuation. Each quarter, our superannuation funds, or whoever your superannuation is with, typically buys the ASX 200, and of course about 9% or 8% of that is CBA. So that means each quarter in, quarter out, a CBA is continuing to be bought by some of Australia's biggest investment managers, including your money, unless you manage your own super and don't invest in banks. So that is something to consider. We have got 5 more minutes. I just wanted to, 2 questions have come through about lithium. Did you want to touch on lithium? I've got some 2 cents to add on lithium.
I know you've been following that sector very closely for a while, Jess. I think you're best placed to answer those.
So 2 questions have come through about, will lithium make a comeback in 2025? And what stock should I buy? Of course, we can't say what stock you should buy, but I can tell you the world's biggest company is called Albemarle, and they're listed in the US. We've seen their shares make a very sharp move to the upside, but they haven't been able to sustain those highs. Perhaps this is a bellwether, or I guess a proxy for the lithium sector that you should keep on your radar. There are lithium ETFs, of course, many that you can buy or find information on our platform. But the thinking is, the initial thinking was actually before China's stimulus came into play, the initial thinking was that the deficit in the lithium market wasn't expected until 2027, 2029. And of course, a deficit meaning there's more demand than supply. A deficit would naturally push up the price of lithium. But so the thinking was that the lithium price wasn't expected to kind of see a run up until 2027, maybe 2029. But if we see China's stimulus that they've dangled the carrot on this week, if we see that materialize, you might want to keep your eye on the lithium carbonate price, and also Albemarle being the world's biggest lithium company. SQM is the world's 2nd biggest lithium company, and they're not only in lithium, but they're more diversified. So going back to Michael's piece about finding a company or investing your own portfolio in a diversified way, that can often help ride out volatility. So SQM is also in fertilizers, and fertilizers are essential in growing our crops. So that could be a stock to consider. Do keep in mind the lithium space is very volatile. Pilbara Minerals is a hotly traded stock on Moomoo, and it's in fact in the top 15 trades by Moomoo investors this year. But I will just hand it back to Michael. Pardon me, I've brought up the wrong slide. Wanted to show you our team and conclude today's presentation.
Well, I don't know who that old guy in the middle is, but you can see here on the left our country head, B. Cheng, and on the right there, Jessica herself. I'd also like to give special mention to our team of analysts who provide us with invaluable information on a daily basis and support the efforts of the Australian office very admirably. It's a team game here, and we certainly look forward to continuing our commitment to the highest levels of service and investment solutions in 2025. We hope that you'll join us for your journey in the investment world on the Moomoo platform, where we aim to make investing easier and a journey that we can all share.
Wonderful.
Thanks, Jess.
Thank you, Michael. It's been a pleasure.
It certainly has. And thanks for tuning in. Keep an eye on the Moomoo community platform for our next webinar.
Happy trading and investing. Bye for now.